Hey, this video is about configuring the two-sided dynamic spread strategy. The explanation for the dynamic spread strategy is already covered in a separate video, which you can see here on Raindex.finance. So Raindex.finance is currently still pretty early in development for the web app. The native app has been out a while longer, but the web app is still pretty new. There's not a lot of strategies up yet, so expect all of this to change pretty soon. Over the coming weeks and months, there'll be more strategies and it will be more flexible in the configuration and more tokens and networks will be supported. But generally, the basic process of filling out the strategies isn't going to change a lot because every strategy consists of the core logic, which is in this case the dynamic spread, the double-sided exponential auctions, which is explained in the other video, and some bindings. So the bindings are configuration that you can set, which allows you to customize the specifics of the strategy. So in this case, we're going to look at Flare and WFlare on Flare. So this is the staked version of Flare, which means that it is accruing rewards automatically under the hood, which is generally a pretty common concept these days, I'd say. You've got your token that represents more of some other token in the underlying as rewards tend to accumulate towards the staked version of the token. So generally the value of the S-Flare token is going to go up relative to the rat flare token, because the rat flare token is not automatically gaining the rewards. So we, in this case, generally expect the dynamic spread to be rotating out of S-Flare as the rewards are going into the S-Flare token, and so it'll be selling S-Flare as the market goes up. But because there's some inefficiency in the markets, because there is, for example, a delay on unstaking, which takes a couple of weeks. So if you take your S-Flare to the portal and then unstake it, you'll see that it takes a couple of weeks before you actually get your wrapped flare back. So a lot of people will prefer not to wait, and instead they will simply sell their S-Flare for the wrapped flare. And when they do that, it can cause the market to temporarily dip below the strict conversion ratio that you'd see on the S-Flare website. And so when the market does that, the dynamic spread strategy is going to try to use the wrapped flare that it got from selling the S-Flare to buy back some of that S-Flare. So it's that typical rotation that is explained in the other video, but we can have a look at the market here. So this is DEX tools, and you can see this is the chart for S-Flare against wrapped flare. So you can see that it's generally pretty stable, which is what you expect for two highly correlated tokens, but occasionally you see there's these spikes in both directions, so up and down. So we have a bit of a trend here, which is probably due to the fact that fairly recently the S-Flare token had a lot of rewards added to it, which you can see on their website. But then you can see historically we have periods where it's relatively flat as well. So we also have these periods where it sort of goes up and down. So this market is not perfectly efficient. So because the market, and when I say that, I mean there's clear temporary ups and downs with some spikes. So because it's not perfectly efficient all the time, there should be opportunities that we can try to jump on with our rotating strategy. It should sell the staked flare during the trends and these spikes, and then it should buy back when we have these downward trends or these momentary spikes downwards, which would represent a larger holder selling their staked flare into the wrapped flare, probably because they don't want to wait to unstake. That's the most likely reason. There may be other reasons. I'm not going to pretend to know why everybody does things in the markets, but this is typically what we look for in a dynamic spread. We do want correlation between the two tokens, but we also want some volatility. That's sort of the key characteristics for the ideal pairings that we have for the dynamic spread strategy, because the correlation means that you shouldn't have sustained trends in one direction where you're just getting heavier and heavier and heavier on one token because the market is moving and moving and moving. And you also want the volatility, because the volatility, so these temporary trends that end up going back to the average, or these spiky ups and downs, you want those as well fairly regularly, because that represents your opportunities to make some profit through the rotations in the strategy. So with staked flare, we know actually that if you zoom out and you leave this for a whole year or months or however long, the staked flare is going to be worth more than the wrapped flare, just because it's gaining rewards. So there is some opportunity cost to running the strategy. So if we initially set up 50-50 in the vaults, you don't have to, but just for example, we have an opportunity cost because one of the vaults has wrapped flare in it, which means that that wrapped flare is not accumulating rewards. The staked flare is. So we've essentially given up half of our rewards to run the strategy in that configuration. So in that case, we want to see the revenue from the rotations to outpace 50% of the base APY of the staked flare, right? Because we still have half of our tokens in staked flare, so we're still getting half of the rewards that we would. So we have to have the overall volume that we get from rotating those tokens with the, multiplied by the percentage of each of those rotations, the profit that it's going to make, to outpace the opportunity cost of not getting the rewards on half of our tokens. Which, with a fairly volatile market, that seems like a reasonable experiment to run. We can see that there's quite a lot of inefficiency here, lots of opportunities. If we just look at this, obviously we're not going to get the absolute maximum and the absolute minimum of these spikes, but if you look at this one here, it's gone from 107 to 111. That's several percent in a single jump. So if we can get enough of these ups and downs, this is on this time scale is only half an hour per tick here. So this is over the course of days we see volatility. So I think it's a reasonable experiment to run to see whether we can outpace the opportunity cost. And generally this is the kind of thing that you would be looking for when you're looking for token pairings. You're looking for correlation and volatility, and thinking about opportunity cost, and thinking about whether it ends up being worth it to run over a long period of time. And it's not always going to be true, because some market conditions are relatively flat and calm, and some market conditions are going to be much choppier and inefficient. So you can't say just because you ran the strategy for a few days and you didn't see anything that the whole thing's a failure. You really have to run it for a long enough period of time that you capture a broad range of market conditions. So that's sort of the high level of what we're going for with this strategy. Now, if we go back to the configuration, the first thing we're going to see is the initial price. So if you remember from the other video, the initial price is where the first two options are going to be centered around, which in this case, if we're looking at the S-flare, wrapped flare ratio, the price that we see here on DEX tools is the starting price. It's a reasonable starting price, actually. So if we put in, this is 128, it doesn't have to be exact, because it's going to set up an auction around this midpoint. So even if this is a bit inaccurate, this isn't exactly what it says here, 12887, I just put in 128. It doesn't have to be exact, it just has to be rough, and then the auctions are going to kick off. And even if the first trade is a little bit lopsided towards the buy or the sell side, it doesn't really matter, because as soon as it does that, it's going to recalibrate itself around that initial trade anyway. So this can be rough. The next question is going to be the next trade multiplier. So this is asking how much the auction is going to jump up when it places a trade. So if we think about it like we have an auction doing this, and then a trade goes through somewhere, it's going to jump up again and then come back down. So this amount that it jumps up by relative to the trade when it went through is this multiplier. So this is a relatively correlated pair. So the presets here are quite tight. The first is 0.1%, 0.2%, 0.5%. You can set up a custom percentage, but for this, I'm just going to say 0.5%, which means every time a trade happens, the auction is going to reset to 0.5% past where the last trade happened. You can see more details about that in the other video. It's quite important to understand, but generally anything in the range of 1% or less than 1% is pretty good, something correlated. The tighter you make this, the more it's going to trade. I think that's the simple take home, because if you make the spread tighter, then each time it resets, it's only going to jump up by a small amount, and then it's going to intersect the market again very quickly. So you get many rapid trades if you make this a small number, but you also, if the market is moving quite quickly, you're going to put more trades in during the movement, which is not a good thing. So a tighter spread here means that you're going to put more trades in during a period of relative stability. So you'll be more able to take advantage of rotations during a relatively stable period, but you're more, I guess, vulnerable is the word. You're more exposed to getting overcommitted to transient prices while the market is moving, because you're not able to jump to the next price level quickly enough. So if we draw that in and say the market was doing this and we put in trades all the way along, our average is going to be somewhere down here. But if we just put in one trade, one larger trade near the end, then our average is going to be way closer to the end. So that's the trade-off here. So there's no right or wrong answers, there's only situational answers. What you prefer based on what you think the market conditions are going to be, you can choose a larger or a smaller trade multiplier. This question about time per halving. So remember that the auction is an exponential auction. So it's doing this, like a curve. It's not a straight line. So each half, or each time period, the curve halves. So if each period like this, we go down half, 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 an exponential curve. So we can make this faster or slower. The general options here are based on hours, because as we saw in the chart before, the volatility is happening on the scale of hours for this particular token quite often. So we can have the auction run down to within a few hours. The slower that you make this, just like the previous question, the longer it's going to take to make the spread tighter. So if you make this very slow, then the spread is going to stay wide for longer, which means you're only going to trade when the spread is wide, which can be a good thing. That just means that you're relatively uncertain. So you don't want to overcommit to any particular price. So you'll take trades where the spread is quite wide between the buy and the sell, so you can make the halving slower so that the spread stays wider for longer. And then your trades, you'll have less of them, but each one will represent a larger percentage profit, right? So if you make this very tight, you're going to have lots of trades around a very small spread. So each of those trades is going to make less profit generally, but you'll have more of them. And if you make it longer, you're going to have less trades, but when the trades do go through, it's going to be a wider spread. So those fewer trades each represent a larger spread, so a larger profit in general. It's not exact, it's based on market conditions, but in general, that's what this means. So we can set this at 2 hours for now. So the maximum amount in a single auction. So when the auction starts, remember that it offers the most tokens at the start of the auction. So as the spread is getting tighter due to the auction, it's also offering less for the trade. So once the spread gets very, very tight, that means that the market is quite slow. So the strategy is offering fewer tokens at the tighter spread because it doesn't want to overcommit to a market that isn't really doing anything, because that means that there's not a lot of price discovery happening, or the price discovery that's happening, we could say the price has already been discovered. It's happening in a very tight range. So we don't actually want to overcommit to that because we have to accept that the market could move. And in this case, we know the market's going to move because the S-Flare token is accruing rewards. So at some point, the market is definitely going to move. So we don't want to overcommit to a very tight spread. So that's why the strategy offers more tokens at the wider spread. This is the maximum amount it can possibly offer. So in the very first second of the auction, this is the amount of tokens that are going to be offered. And this strategy is denominated in S-Flare because the S-Flare token is the one that the rewards are accruing to. We generally are going to treat that as the reserve token in this strategy, or that's to say this is the token that we think it's going to hold its purchasing power better over the long term, which I think makes sense because there's no rewards going to wrap flare. The rewards are going to the staked flare. So because they're going to the staked flare, that is the token that's going to be worth the most or the most stable amount over the longer period of time. So that's the one that we're going to denominate all the amounts in for this strategy as it's configured currently on the DEX. So we could say, let's offer a maximum of 1,000 per auction. So the auction's going to start offering 1,000. And then the next logical question is the minimum. So when the auction gets right down to its lowest point, which is going to be getting exponentially closer and closer to it, never actually hits it, but it just gets closer and closer, what is the smallest amount of flare that it's going to offer? So I said 1,000 before, so let's say 100 for this. And then the minimum trade amount, this is not what you're offering. This is the smallest that somebody else can take. So in general, this is probably more of a implementation detail than something you really have to worry about, because it's basically preventing somebody from coming in and putting many, many small trades into your auction and causing your auction to constantly reset itself just because somebody's coming in and basically griefing the auction by putting in 0.1 flare or some tiny amount. So this is the smallest trade amount that somebody can take on the other side of the trade and still have that be accepted as something that can reset the auction up to a higher price point. So because I just said the minimum that the auction is going to offer anyway was 100, and 100 flare is not a particularly large amount anyway, I'm just going to go ahead and say the same thing for the minimum trade amount. So that's 100 too. Most of the time it's going to go through for more than 100 anyway, so it doesn't really matter. And then here it's going to ask me to deposit some S flare and some wrapped flare. So you don't have to actually set this. This is just a convenience thing if you want to have the depositing of the tokens and the deploying of the order all wrapped up in a single transaction as a multi-call. Then you don't have to have multiple transactions being submitted on chain. It's convenience. If you don't want to do this, personally, I like to review things a little bit more. So I like to set it at 0 for my deposit and then 0, and then you get to review everything. And if I click deploy, that is going to pop up Ravi for me. That's the wallet that I use, and then I can deploy it. And then I will be taken to the actual strategy review screen, and then I can check the prices and I can deposit from that screen in exactly the same way that I can deposit here. So this looks good. The initial price 1.28 matches where we are here at 1.128. Oh, actually, no, it doesn't. I got that wrong. So we can go back through here. Same options, 1,000, 100, 100, 0, 0, 1.128, 1.128. Next trade multiplier 0.5%, time per halving, that's 2 hours. That's the max amount per auction, the minimum amount per auction, the minimum trade size, 0, 0. That looks good. So I would be happy to deploy this. These values that I've chosen, please don't take them as some kind of gospel or the best possible values for this pair or anything like that. The whole reason that this is a form that you can fill out is because it's something that needs to be experimented with. There's no definite right answer for any of this. This is exactly where the hard logic of the strategy is handed over to the subjective and, I guess, the art of observing the market, thinking about how you want to trade, how much money you want to commit to things, how much you want to manage things, etc., etc. It's all going to come down to personal preference and experimentation. So hopefully everyone can take what I've just explained here with the bindings and start experimenting with these pairs. And there's other pairs on the DEX, and there'll be more pairs going up. If you want a pair added, just at me in the Telegram, and I'm sure in a few weeks or months we will have this set up so that you can pick your own tokens and you don't need the token pairs to be preset in the website. Everything should be a drop down that you can just select token pairings and things. So that's an obvious feature on the roadmap. So if you're watching this video in the future and you can pick your own token pairs, that's great. But in the meantime, just at me on Telegram if you need anything, and we will update it so you can deploy whatever you want, whenever you want. Thank you.